All right, friends, welcome to you all around the world. Welcome to the Follow the Money podcast. I'm Jerry Robinson. Great to be here today. Today we have a timely topic lined up for you about the financial markets and how they're poised to respond to the anticipated changes in monetary policy. So the Federal Reserve is very likely to begin cutting interest rates later this year. Specifically, we're targeting the month of September. That's what the futures market seems to be expecting. And there are several key markets that are on our radar for potential rallies heading into that rate cut announcement and also even after, especially as rates begin to fall. You know, savvy investors understand where to look when these financial winds shift. And today we're going to explore some specific markets that historically benefit from falling interest rates. We'll take a look at some of the obvious spaces like bonds and real estate, and we'll even touch on how alternative assets like Bitcoin respond to easier monetary conditions. But that's just a glimpse. We'll uncover more markets in our detailed discussion that could offer, I think, profitable opportunities as rates decline. Look for that in segment 1. Then in the second segment of today's episode, we're going to bring you the latest updates from the stock and crypto markets. We're going to examine some of the key players like the S&P 500, the NASDAQ 100, along with some key commodities and cryptocurrencies. We've heard from many of you over the last few months that you appreciate these updates on the markets, and so we'll keep them coming. And then finally, we'll wrap things up with some final thoughts on how you can adjust your investment strategies, not only to safeguard your assets, but also to potentially capitalize on the market shifts caused by the Fed's upcoming rate cuts. So whether you're tuning in today to refine your portfolio strategy or simply to stay ahead of the curve, today's episode promises to deliver some really important insights that will help you navigate the complexities of investing in a changing economic landscape. Let's get ready to unlock the potential in these markets together. Stay with us as we dive deep into these opportunities right here on Follow the Money. All right, friends, welcome to episode number 466, entitled 6 Markets to Watch When Rates Drop. I'm looking forward to today's episode because we are expecting the first rate cut from the Federal Reserve by September. In fact, we have been looking specifically at this for pretty much the entire year, trying to figure out when the Fed is going to actually begin to cut rates. And you know, there's a lot of things that go into calculating when to raise rates and when to cut rates. And the Federal Reserve is not so keen or not so, let's say, successful at timing its rate cuts and its rate hikes. And so therefore, you do have to use a little bit of creativity as you're looking at what the Fed might do and when it might do it. And so we are looking right now at a September rate cut based upon several things. And let me just briefly talk about some of the reasons why we expect the rate cut to come by September. And then I want to share with you 6 markets that I think are poised to do well amid a falling rate environment. Some of these are going to be obvious, maybe not all of them. And I think they'll be helpful to you as we move into the remainder of this year. So first of all, if you saw the latest jobs report that came out for the month of June, that jobs report sent the stock market rallying to another fresh high. So we have seen numerous record highs set in the S&P 500 and the NASDAQ 100 this year. And in the wake of that June jobs report that came out last Friday, we did see the market just push even higher. We saw yields fall. And that was largely due to the fact that the unemployment rate rose to 4.1% in the June jobs report. That shows that there is some slack in the labor market, and this is the first time since 2021 that the unemployment rate has actually been above 4%. And so that is signaling to economists, to analysts, that we may have a potential cooling of this robust jobs market, and that would certainly influence the Fed to consider easing monetary policy to support employment. We also saw slower wage growth in this latest report. The average hourly earnings rose by 3.9% in June from a year earlier. That's the smallest gain we've seen since 2021 and suggests that inflationary pressures from rising wages may be diminishing. We also see a rising labor market participation rate that rose to 62.6% in the month of June. That indicates that more people are entering the labor market, and it's a positive sign overall for the labor market health, but it also suggests that the previous tightness that we were seeing in the labor market may be easing. We also have the investor sentiment in reaction to that June jobs report, where, as I mentioned, stocks rose, Treasury yields declined. That reflects a specific investor optimism that the Fed may be more inclined to cut rates sooner rather than later. And then finally, there is the Fed funds rate futures market. The futures market has been anticipating the first rate cut to arrive in September for at least a few months now, but the probability of a September rate cut rose from just over 60% just a few weeks ago to now nearly 75% in the wake of that release of the June jobs report. And there's plenty of other things happening besides last Friday's report, because this week we have Jerome Powell testifying on Capitol Hill before the Senate and before the House. And we also have some really key inflationary figures coming out on Thursday and Friday. On Thursday, we're going to get the headline CPI numbers. That's going to be the inflationary figures for the month of June. We'll also get the core CPI that day, and then we'll get the wholesale inflation figures, the PPI, on Friday. So those numbers that come out on Thursday and Friday could be not just market moving, but they could also change the trajectory in even a more significant way into expecting a September rate cut, or they could potentially harm that trajectory if those numbers don't confirm a disinflationary trend is firmly intact. I believe, however, that we're going to see good numbers in those latest CPI and PPI numbers that come out this week, and I think it'll further confirm the fact that we are heading indeed for a rate cut as soon as September. So let's suppose that we're right. Let's suppose that the Fed is going to cut rates by September, very likely at the September meeting, which is going to be, I believe, on September the 18th. What should we then expect? Well, let's say a couple of things. The first thing we want to suggest is the fact that we could see the market rally into that news and then sell off on the rate cut. In fact, this has happened numerous times throughout history, where we have seen markets actually go down, stocks and even other markets go down once the Fed begins to deliver the rate cut. Now, there's a couple of reasons behind that, but mostly it's due to the fact that there is a perception that if the Fed is cutting rates, well, it's cutting rates because the economy is not strong enough to handle those those current rates. And so that indicates in some ways a slowing economy. And so that can often spook investors. But what I have found, historically speaking, is that often serves as an opportunity for savvy investors to begin to accumulate on that weakness because it often resolves in those asset prices moving higher as those interest rate cuts begin to take hold and as they begin to pile on top of each other. Realize that the current rates right now, the Fed funds rate's about 5.25 to 5.5. It's fairly elevated. And so as the Fed begins to cut rates, maybe 25 basis points or even 50 basis points at a time, it's going to take a little bit of time for it to unwind those rates back to a natural rate of, say, 2 or 3%. And so that's going to provide what I would think is a tailwind for several markets that would be poised to benefit from declining interest rates due to their sensitivity to borrowing costs and liquidity conditions. And so today in this segment, what I want to do now is I want to get into those 6 markets that I believe that could rally as we begin to move into this declining rate environment. I'm not saying they're going to move up immediately because, again, we have often seen that these markets that even benefit from falling rates will often sell off when the rate cut comes. Kind of one of those buy the rumor, sell the news. We anticipate the rate cut, and then when the rate cut finally comes, there's a sell-off there. I wouldn't be surprised in the least if we see a sell-off associated with the first or second announcements of rate cuts. However, I think overall it will resolve higher as rates begin to come down. So let's talk about those 6 markets that could rally amid these easing rates. And the very first one is the most obvious. It is bonds. Bonds typically benefit from declining interest rates because their yields become more attractive relative to newly issued bonds. So when rates fall, the prices of existing bonds rise, and that leads to gains for bondholders, right? And additionally, you have the lower rates that reduce the cost of borrowing, and that potentially improves corporate bond issuers' credit profiles, and it leads to a rally in both government and corporate bond markets. At least that's what we've seen over time. If you look at the 10-year U.S. Treasury yield right now, which is the benchmark for borrowing costs all around the world, it's sitting just below 4.3%. Now, it got as high as 5% late last year, so it's certainly trading off of its peaks, but it's still very elevated historically, at least relatively to the last several years. We see it sitting, at a level we haven't seen in some time. And so we believe that this is slowly going to come down. The 10-year will slowly begin to come down, not immediately, not rapidly, but slowly. And that will lead to gains in bonds across the yield curve. But specifically, we're looking at high quality corporate bonds and also even those 20 plus year treasury bonds. And so we actually have put out a recent video for all of our members where we went through several markets and we talked about specific stocks and ETFs that we would be looking at in this environment. Today, I'll just mention one for each of these ideas. But if you want more, obviously we have a lot more on our website, followthemoney.com, for our members. But today, we can look at one, say, the iShares 20-plus year Treasury Bond ETF, TLT. That one has a really solid support range, anywhere between 80 and 85, and it's just trading right above that right now. So we do believe that ETFs like TLT stand to benefit as rates begin to come down. Bond prices go up in that environment. So that's certainly one area we're watching that I think is fairly obvious, that as rates come down, bond prices go up, and that's just good for bonds across the board. So let's move to the second idea. The second idea for an asset that will very likely do well amid easing rates is Bitcoin. Bitcoin is something we have been talking about on this broadcast for well over a year. And many of our members were able to buy Bitcoin when it was trading for much, much less than it is today. Even many of our members buying it for less than $100, some of them buying it for less than $1,000, because we've been talking about it for so long that many of our members have been able to do that. Well, we are not bearish on Bitcoin whatsoever. We continue to be as bullish as we ever have been. And when we look at Bitcoin and other cryptocurrencies, we find that they often benefit also from a easing interest rate environment. So easing rates lead to a weaker dollar, and that makes Bitcoin more attractive as an alternative asset. So too, lower rates typically boost liquidity in the financial system, which frees up money to be able to drive more investment into these riskier assets like Bitcoin. Let's admit it, Bitcoin is a riskier asset in the fact that its volatility can be pretty wide-ranging. But historically, Bitcoin has seen price increases during periods of monetary easing. I'll get a bit more into the price action in Bitcoin in our second segment. I want to talk a little bit about its current price range and where it's at. But for now, just realize that we're in a cycle that should see Bitcoin go up, not just even later this year amid falling rates, but even into 2025 and even well into 2025, as we have talked about on this broadcast in several recent episodes. So, and if you're curious about that, go back in our archive and you'll see many different episodes on Bitcoin, including ones where we provide our price predictions and forecasts and things like that. Okay, so the second idea there is Bitcoin, and there's obvious ways to buy that. You can buy that outright through a crypto exchange like Coinbase, or you can go and just buy an ETF now, a spot Bitcoin ETF. Our three favorite, well, I'll just say our two favorite Bitcoin ETFs right now are the iShares Bitcoin ETF, that's IBIT, and the Fidelity Bitcoin ETF, FBTC. Now, I, in full disclosure, own a little bit of IBIT. I bought that a while back when it first came out. I prefer to hold physical Bitcoin, but I do like the exposure. I do like, having the idea of how the Bitcoin ETF exposure works, just to see how, it keeps track with the overall Bitcoin price. So far, I've been very impressed. But it's similar to gold and silver. I prefer to invest in the, in the physical as opposed to the ETF if I have the opportunity. So there's the second idea. Bitcoin, we fully expect it's going to do well amid a easing interest rate environment. Let's talk about another. Number 3 is small cap stocks. Now, we entered 2024 and expecting that small cap stocks would do better than they've done so far this year. In fact, in our 2024 market outlook, we had listed small caps as one of the 9 markets that we expected to outperform the S&P 500 in the year 2024. Well, we're 7 months into the year, and small caps have been just hanging out near 0% return. I mean, they really haven't done anything at all. Now, that doesn't mean that they're not going to have a good rest of the year. And it still doesn't mean that we're wrong that small caps won't outperform the S&P 500 before the end of the year. So we still have a few months left. And the reason why we remain bullish on small cap stocks here is because they tend to outperform in a declining rate environment due to lower borrowing costs and typically improved economic conditions. And so these companies have higher growth potential, and they're much more sensitive to economic changes, and lower interest rates, of course, spur consumer spending and business investment. And that benefits small cap companies that are usually more reliant upon the domestic market than large cap companies, which have obviously a much broader global customer base. And so they're not so dependent upon the domestic market. Well, here we have these elevated interest rates, and that can hurt small cap stocks, especially those who are dependent upon financing. Many of them are. And of course, their borrowing costs are more expensive. So again, we think that the small cap universe is going to benefit from falling rates. And one of the simplest ways to get exposure to small caps is through the Russell 2000. You can find Russell 2000 based ETFs out there. The most popular one is put out by iShares. We think that we're going to see, after a very lengthy consolidation in the Russell 2000. By the way, the Russell 2000, which is the small cap index, touched a high in late 2021 and has not seen a new high. I mean, despite the fact that you've seen the S&P 500, which is predominantly a large cap index, rise to new highs. Of course, it's hit many new highs this year. The NASDAQ 100 hitting, new all-time highs. But the Russell 2000, this major index, just not moving. It's really just kind of grinding sideways. I think that the longer you see that, the more sizable the move could be to the upside. So we are bullish on small caps, especially amid a falling rate environment. Now let's move to the fourth idea, and that is physical metals. So gold and silver prices typically rise when interest rates decline. So lower rates, of course, reduce the opportunity cost of holding non-yielding assets like precious metals. They don't pay a yield. And so whenever you can go get a yield on your money, you can take your dollars down to the bank and get 5% or whatever in some CD. Well, that's an opportunity cost that would be against holding physical metals that don't yield anything. And so that's a big deal. And additionally, as you have easing rates, that again, of course, leads to a weaker dollar, which further boosts the appeal of gold and silver as hedges against currency depreciation, debasement, and all of that. So we are bullish on gold and silver. Now, we entered the year expecting them to outperform the S&P, and so far, so good. Gold and silver have done very, very well this year. Silver in particular, up nearly 30% the last time I checked. It's had a great year so far in 2024, and we don't think that's over. We think there's more upside ahead. In fact, right now, we're seeing gold consolidate below 2450, and we're seeing silver begin to rise from its recent slumber down around 29, where it kind of consolidated down in the $29 area, but it's still trading right below a 32.75 peak that it hit back in late May. And so we're bullish on both gold and silver, and some like to invest even in gold miners and silver miners. I think that those will also do well in this environment. Some of them have failed to keep pace with gold and silver in 2024. That could change as we move forward. The miners often outpace the metals over time in the cycle, and silver often usually outpaces gold in the cycle, but only towards the end of the cycle. So right now, we've seen gold really be the superstar, and then silver is starting to pick up, and we're starting to see it begin to outperform gold. So we could be in the early innings of what becomes a very nice bullish cycle for precious metals. We've already seen gold touch a new high. We've seen silver still way below its 2011 high of around $50. But I think over time we're going to see that change, especially as the dollar comes down in value. The dollar index has been stubbornly high because of interest rates. But as interest rates come down, we expect the dollar also to follow, and yields, and that will, in essence, we believe, put upward impetus upon things like gold and silver. So that's the fourth idea. And of course, we like physical gold, we like physical silver, and we've been bullish on those for many, many years, not just on an annual basis. We've been more bullish on them certain years. But the point is, we like to hold those physical assets as hard assets within our portfolio to provide us some insulation from paper assets. Now, let's move to the final couple of ideas as we conclude this first segment. The fifth idea is real estate. So real estate stocks, including REITs, which we also like, generally perform well in a low interest rate environment. And that's because lower borrowing costs makes financing, which is, real estate is heavily focused upon financing, it makes it more affordable for property acquisitions and developments, and it boosts profitability. And so too, mortgage rates have kind of stifled the real estate market. It's not that mortgage rates are just prohibitively high, but we have these elevated mortgage rates, and we have a tight inventory in many parts of the country, and that is kind of complicated the picture for real estate. And so as we see lower interest rates, that's going to trickle down into lower mortgage rates, and that can help drive demand for housing and commercial real estate. It could also help increase the value of real estate assets and the income that's generated from them. So we do like real estate. Now, I like physical real estate, of course. I like to invest in real estate, but you can also get exposure to real estate through the stock market. One of the simplest ways to get holistic exposure to the real estate sector of the S&P 500 is through the S&P Real Estate Sector ETF, which is ticker symbol XLRE. Now, that one is also trading below its 2021 peak. And so real estate looks a lot like small caps in the fact that it peaked out in late 2021, early 2022, and it's just never been able to get back to that level despite many other sectors moving higher. So real estate, which has really kind of suffered in this high interest rate environment, I think is also poised to do well. I think there's a lot of opportunity in real estate stocks and also real estate in general. But when you look at the stock market, I think there's some REITs and there's some real estate companies that could really do well amid falling interest rates as we see that kind of begin to happen. And then finally, the sixth market that we expect to do well in time of easing rates is the solar energy space. Solar energy stocks, I believe, are poised to benefit from declining interest rates as they often require significant upfront capital investments, right? And so taking on a big solar energy project, if you're a big commercial player or even a government, you're looking at those financing costs, and lower borrowing costs can make it cheaper to finance new solar projects, which obviously makes them more attractive. So governments and businesses are always seeking sustainable energy solutions, solar energy, and the demand for it is likely to rise. That's going to boost the sector or the industry over time. But easing rates can also stimulate broader economic growth and support higher energy consumption and investment into renewable energy infrastructure. And so companies in the solar energy space have been beaten down very dramatically. And I think this is another area of opportunity. Now, one of the simplest ways to get exposure to the solar energy space is through ETFs. You can just buy a big basket of stocks in one single ticker. And the one that we track, now I don't own this ETF, but the one that we track for our members through our ETF leaderboard is the Invesco Solar ETF. And if you look at that particular ETF, it's really been beaten down. It's trading well below its peaks as well that were reached, back in 2021 or so. And so again, these markets are, I think, poised to do very well. Now, we have some favorite solar energy stocks. We have some favorite real estate stocks. We have some preferred mining stocks in the gold and silver space. We have a few favorite ways to play small caps. We also have a few favorite Bitcoin mining stocks. All of that we share with our members right here at followthemoney.com through our many different member resources, particularly our weekly strategy call. We do a Trends and Profits webcast every single Tuesday at 10 o'clock Central Time. And that's where we provide a lot of ideas, provide market updates and whatnot. If you're not currently a part of Follow the Money membership, you're not currently a member of our club here, you can go to followthemoney.com/join and check out our memberships and see if one is right for you. But if you're looking for more specific ideas, but these 6 markets, I believe, are poised to do well. Let's wrap them up again. We got number 1, bonds, number 2, Bitcoin, number 3, small caps, number 4, gold and silver, and I think also platinum should go into that list. Number 5, real estate, and number 6, solar energy. So remember, while these markets offer exciting prospects, it's crucial to approach each investment with a balanced view, considering both the potential rewards and the risks. So make informed decisions based on thorough research and seek advice from financial experts, of course, to tailor your strategy to your personal financial goals. Stay tuned as we shift our focus in the next segment to the latest movements in the stock and crypto markets, where we'll decode what recent trends could mean for your portfolio. I'll see you on the other side of this break.
Welcome back to Follow the Money Weekly. And here's Jerry Robinson.
All right, friends, welcome back to one of the longest running personal finance podcasts on the internet. My name is Jerry Robinson, founder of followthemoney.com, author of the book Bankruptcy of Our Nation, and a coach to many different traders and investors around the world. It's great to have you here. I love spending time with you right here on this broadcast. Now, let's move into segment 2. We're going to be talking about stocks and cryptocurrencies. I want to begin with the largest and most relevant index in the United States, and that is the S&P 500 index, which just continues to push to new highs. In fact, the S&P has registered, I want to say 35 or 36 record closes in 2024, maybe more, but I'm pretty sure it's around that number. It's had 4 positive weeks out of the last 5, and investors just continue to push the equity markets higher. So we see, as I record this on Wednesday, the 10th of July, 2024, the S&P 500 now trading above 5,600, very likely on the comments that are being made by Federal Reserve Chair Jerome Powell in his testimony before the Senate and the House this week, as he indicates that the Federal Reserve has made considerable progress in its battle against inflation, which many would blame the Fed for helping stoke that very same inflation. We'll see if they can actually have a good balancing act here as they try to land the plane. We'll see what happens. But regardless, the S&P 500 continues to power higher. We have been watching that 5,000 psychological support level, but we're well past that now. So if you're looking for a area where you would find support on the S&P 500, you would be looking at around the 50-day moving average, which is currently around 5340 or so. And again, with the index now above 5,600 and new fresh record territory, there's just a lot of potential. I think there's a lot of potential upside to this market. I think that we are still in the early innings of what's going to be a multi-year rally. I mean, I think we are really in an environment now where we're going to see equities moving higher, especially with those rates coming down, albeit not straight up. Of course, we will have challenges along the way, and I will view those, quite frankly, as opportunities, especially in many of the companies that we follow specifically. Now, we look at the breadth of the S&P 500. We see about 66% of the stocks trading in the S&P are trading above their 200-day moving average. That's a bullish signal. It's certainly off of its highs. If you go back to, say, the beginning of April of this year, around 80 to 85% of stocks in the S&P were trading above their 200-day moving average. So despite the fact that we have moved up in price, we have not really seen that translate into a broadening out of the market at this point. We still have, again, 66%. That's 2 out of 3 stocks in the S&P trading above their 200-day moving average. But that leaves plenty of room for expansion back to that 80, 85% level where you tend to get, pullbacks. The last time we were at the 85% level, like as I mentioned back in early April, we alerted our members probably need to be ready for some sort of pullback. And that's exactly what we saw. But overall, things looking very good from our perspective on this. Now, if we look at the NASDAQ 100, this is a market that we like to invest in and we like to trade around. This has been a trading niche of mine, for many years. I like the NASDAQ 100. I find it to be quite a profitable market without that single stock risk. And the NASDAQ 100, recently pushing past 20,000. It's also trading at a fresh record high as we speak. I typically will follow the ETFs with the NASDAQ 100. One of the most popular and most liquid NASDAQ 100 ETF is QQQ. It's currently sitting at just above $500 now. And again, with this one, you would find immediate support at 490 and then secondary support at around, say, 455 to the 460 level. That's what we're watching on the NASDAQ 100. Now, when we take a look at gold, we've seen that gold has been struggling below its 2450 peak that it hit not too long ago. In fact, it was back in May where we saw it briefly touch that 2450 level. It's currently trading at about 2385 or so. So it's trading just below that really key area. And we think we're going to see another breakout to a fresh record high on gold sooner rather than later. Even the gold-silver ratio right now is trading at about 76, and that's the lowest that it's been, quite frankly, since 2021, as gold just continues to do well, and silver also continues to do well, and it's been rising as of late, which has also been helping move the needle on that gold-silver ratio. Now, let's talk about silver as well, because silver is another asset that we like to follow, and it's currently trading at about just slightly above $31. Now, it's trading below its $32.75 peak that was also hit back in May, and we also think that silver is going to move higher, even above that, later this year, especially as interest rates begin to come down. That's going to, again, put pressure on the dollar, which is going to push up the price of silver. Now, we can see silver getting back to its former $50 peak that was hit back in 2011. Not immediately, but over the coming months and years, I believe we'll definitely get back to the $50 level and likely even go past it. But if you look at for example, a ratio chart between silver and the S&P 500, it's just dismal. This price of silver has rarely traded this low in terms against the S&P 500. So there's a lot of room there for physical silver prices to move higher. And then let me just talk about one more market before we get into Bitcoin and Ethereum, because I want to talk about those two markets as well. The US dollar. So the US dollar has really had some strength going on in this environment because of interest rates. So when interest rates go up, the value of the dollar index, or the price, also goes up. And when interest rates go down, well, the dollar also correspondingly goes down. And right now, the dollar looks a lot like the 10-year yield in the fact that it's not trading at its highs, but it's also stubbornly elevated. And we believe that as those rates come down, that's going to put pressure on the dollar to go down as well. And that ultimately leads to higher prices in terms of assets, inevitably. And so right now, the US dollar is still hovering just above its 200-day moving average, which is currently at about 104 or so. And the value of the US dollar index is trading at about 104.75. So it's very close now to breaking down below a key support level. We expect that the dollar will probably make a good 10 to 15% drop from now till probably this time next year. We're going to see it gently come down. I don't expect it to fall off of a cliff with interest rate cuts, but I do expect it to start sloping down gently and certainly taking out some of the recent lows that it's had, say about 103 or 102, even down to the 100 level. I expect that we'll see the dollar below the 100 level by, I would say, probably this time next year, for sure. Maybe even by the first part of next year, based upon how aggressive the Fed is with their rate cuts. And I don't expect them to be too terribly aggressive. In fact, I expect them to be somewhat cautious as they begin. So the dollar continues to remain somewhat elevated, but it continues to reject a resistance area if you follow the US dollar index, 106 to 108, that area has been very, very stubborn for the dollar. So we don't expect it to really get back above that at all. And we do expect it to come down. That's going to put upward pressure, as I mentioned, on asset prices across the board. So that's bullish if you own, assets here in the United States. Now, let's talk also briefly about Bitcoin. So if you go back to the beginning of 2024, we saw a very impressive rally in the world's largest digital currency, Bitcoin, but that appears to have lost some upward momentum as it continues to struggle below the $60,000 level. And since early June, Bitcoin has been in that price slump. Now, the recent price weakness, which comes around 3 months after the latest halving. We did a big episode on the halving and what it means recently. You can go back in our archives and see that. But we've seen that price weakness accelerate over the past week or so as the digital currency fell to fell as low as 53,500 last Friday. So while Bitcoin has since rallied from those lows and it's currently trading, say about 57, 58,000 right now, it still remains under some near-term selling pressure. We have a couple of catalysts that are pushing down the price of Bitcoin right now. They're both near-term catalysts, so they're not like permanent structural problems with Bitcoin. It's just simply that we have some near-term supply overhang. Where are these coming from? First, a major catalyst for the recent sell-off has been the distribution of $8 billion in Bitcoin from the defunct Mt. Gox exchange. Now, if you've been around the Bitcoin space for some time, you may remember the Mt. Gox platform. That failed, by the way, back in July of 2014. Many people used Mt. Gox for trading and exchange purposes for crypto. We never used Mt. Gox, but I was around and a Bitcoin investor whenever it failed. So I remember that very well. That failed back in July of 2014 when Bitcoin's price was a mere $600. And that means that at today's value, these investors who are getting paid back the Bitcoin that they lost in that exchange way back, 10 years ago, are sitting on a potential 10,000% profit. The big question is, are they going to sell or are they going to hold? And, even though these creditors have been they have to wait up to 3 months to access their funds. This news is spooking the market, and it's prompting some current holders of Bitcoin to sell because they expect further declines. Now, I'm not too much of that opinion. When you think about the Bitcoin that's coming into the market from Mt. Gox, it really represents a drop in the bucket. The Bitcoin market is trading, currently at around a $1 trillion market cap right now. So $8 billion is not that big of a deal, but in the near term, it's understandable that we are seeing some price volatility from that fresh supply that's just coming into the market. Additionally, you have selling pressure from the German and U.S. governments. Both of them have been transferring substantial amounts of Bitcoin to exchanges. They typically do that when they're going to sell it. The German market in particular has been selling hundreds of millions of dollars worth of Bitcoin recently that it seized earlier this year from a now defunct movie piracy website. And some in Germany have been, complaining about this, saying, why are you selling, these Bitcoin? We could hold these in reserve for our country. But the country is selling Bitcoin, and that's also creating a supply overhang. But despite these near-term pressures, Bitcoin's long-term fundamentals, I believe, remain very robust. And if you look at the technical indicators on the chart, if you look at cyclical analysis as well, I believe it suggests that higher prices are ahead for Bitcoin in the coming months. So I expect renewed interest from investors as the market digests the current selling pressures. And if you look at the recent inflows into Bitcoin ETFs, I think that's very bullish. We're seeing those begin to rise again. And we also see that there's potential regulatory clarity on the way from Washington. That's really good news. Additionally, you have this other factor for Bitcoin, that you have what we call the Trump trade scenario, which is the possibility of having a president that is crypto friendly. Now, Trump was not friendly to Bitcoin when he was in office. But as he's trying to get back into office, politicians will do and say a lot of things. And apparently he has dialed in to the Bitcoin community and is attempting to use that as a way to garner support for his presidential campaign as we head into the election in November. And so if Trump really is Bitcoin friendly, as he's suggesting in his campaign, if President Trump is the same as candidate Trump when it comes to Bitcoin, that could really spark a year-end rally. And even if he's not, I think just the rumor, just the expectation of him being that way could spark a year-end rally. So I think Bitcoin, while it currently faces some headwinds, I believe the selling pressures will soon pass. If you look at the chart, I suggest that long-term investors keep an eye on the key support level between 50,000 and 59,000. I personally suspect that Bitcoin will hold above $50,000 support despite the current selling pressure. And I believe that Bitcoin could touch a fresh record high by the fall of this year even, with many more gains ahead in 2025. So I am definitely remaining long on Bitcoin as we head in to the future. Also, it's interesting as well to see that Bitcoin has been bouncing off currently of its 250-day moving average. If you apply that moving average to your chart, you'll see the 250-day moving average serving as support right now, currently sitting at about 55,000 on that. So it does appear that we are seeing Bitcoin move up a little higher. Watch that $50,000 to $59,000 level. I would say that's where we're going to find key support in this environment right now. Now, turning to briefly, I want to add one more, and that's Ethereum. So Ethereum, we are expecting those spot Ether ETFs to be made available either this month or maybe next month to U.S. investors. That's going to be a big deal. Remember what happened with Bitcoin after it got its spot ETFs. Well, Ethereum is next in line. We know that behind Ethereum, there's going to be likely a Solana ETF. We've already seen Van Eck and a few other ETF issuers apply to the SEC for a Solana ETF. But right now, we're looking at Ethereum, and Ethereum is trading just right at its 200-day moving average right now after briefly slipping below it amid all of this selling pressure on Bitcoin. We've seen a pretty big drawdown in cryptos across the space. Ethereum is another one of our favorite projects. We began profiling it to our members way back when it was just $12. So it's certainly, we've seen a really big rally, of course, since that time in Ethereum, where it trades now near $3,000. But we think there's much more upside ahead for Ethereum, especially in this cycle. So it's just now trying to climb back above its 200-day moving average. That's an interesting place. It does have incredible support at the 2750 level or so, 2800, let's call it, right in there. And that's where it's kind of rallying from right now. So we do expect to see Ethereum continue to push higher into the end of the year and especially into next year. But again, watch that immediate 2750 to 2800 support on Ethereum. And then if we break out above 4,000, then I think you will see very quickly a new all-time high on Ethereum, which was last hit, by the way, back in 2021 when we got up to around 4,850 or so. So I think that certainly could happen for Ethereum in the coming months if it's able to clear that $4,000 resistance level in the near term. All right, friends. Well, as we wrap up today's episode, I think it's important to reflect on the insights we've gathered and the strategies we've discussed for navigating markets in this changing interest rate environment. We've explored how different markets can react and potentially thrive as rates drop. And these insights can serve as powerful tools for shaping your investment portfolio, but the ultimate success lies in your hands. And this brings me to a profound truth shared by the legendary investor Benjamin Graham, who once said, "The investor's chief problem, and even his worst enemy, is likely to be himself." This quote really encapsulates the internal battle that many of us face in the financial world. It's a reminder that while markets may fluctuate and opportunities may arise, the greatest challenges we often face are our own fears, our own biases, and our emotional reactions. Understanding and managing these internal conflicts is just as crucial as understanding the markets. So as we move forward, I encourage you not only to apply the knowledge you've gained from today's episode, but also to strive for self-awareness in your investment decisions. By conquering the enemy within, you unlock your true potential to make wise and profitable decisions and investments. And that's just something to think about. Thanks again, friends, for joining me on today's Follow the Money podcast. It's always a pleasure to dive deep into these topics with you. And don't forget, you can find more resources and detailed analysis and our latest trading and investing ideas on our website, followthemoney.com. And if you enjoyed today's discussion, please consider subscribing to our podcast on your favorite platform and share it with others who might find it beneficial. And we also love hearing from you. So if you have any questions or topics you'd like for us to cover in future episodes, reach out to us through our social media channels or just email us directly right there on our website, followthemoney.com/contact. Your input helps us make this show even more valuable for you. I hope you'll join us next time on the Follow the Money podcast, where we continue to decode the complexities of the global economy and provide you with knowledge to make smarter financial decisions. And remember, when you want the truth about the global economy, just follow the money. Until next time, my friends, God bless.
Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any financial